Okay, guys. So the first thing is first, how is the class? I'll just brief you on that first, although I did mention in the uh, demo. How things are going to work for us is basically first 10 minutes, basically from 2 p.m. I will ask questions from the previous class. So you need to study and come, ask questions from previous class. So obviously, this is the first class, so there are no questions. But 2 to 2:10, this is what we are going to do. Then after that, 2:10, I will start the class. Teach. The first round of teaching will happen after that. Then I'll take a break. Then the second round of teaching will happen. And then last 10 minutes, we will do a review, which will be from 4:50 to 5 p.m. There will be a quick review, right? So from basically, I technically have 160 minutes to teach, right? And the schedule would be, think about it, 10 minutes gone from the beginning, 10 minutes gone in the end, and 10 minutes. So basically, we have 2.5 hours of effective class, right? So it is 1 hour, 25 minutes. Sorry, 1 hour 15, 1 hour 15 minutes each. So from 2:10, I will start. 1 hour 15 minutes will be 3:25. So 2:10 to 3:25, there will be the first session. And then 3:25 to 3:35, there will be a break. And then from 3:35 to the 1 hour 15 minutes that I talked about, 3:35 to 4:50 will be the second round. That is how the class is going to be structured. And again, I expect all of you to be sitting with a mic and a proper internet connection. And the ones who are attending it live, please make sure, even if you are online, doesn't matter, please ensure that the entire class you attend live. Otherwise, the continuity will be lost. Now, the first thing that we're going to look at in today's topic is basically the introduction to financial management. Okay. What is, again, if I have to give you a brief on financial management, what is it and how does it happen? Right? Tell me something. Suppose you have cash. Do you want to be careless about it? No. Hashika, you said your name, right? Hashika. You've seen me before in Etiraj somewhere. You've not seen me. Which department? Yes. Okay. So if you have cash, do you want to be careless about it? No. The obvious answer is no. Correct. In your life, you want to manage finances well. You want to make sure that you use your money properly. You don't waste money, want to waste money. You want to invest money in the right investments. Okay, let me ask Jigyasa, do you want to invest your money in an absolutely wasted investment? Obviously not, right? So you want to make sure that you invest your money in the right place, right? You want to ensure that it is invested in the right place. You want to also make sure that when it comes to using the money, it is used properly. So it's all about money. Everywhere there was money. Basically, what we're saying is your finances need to be managed well. And in this paper, I will teach you how to manage your finances. As simple as that. We will see where to invest money, right? First thing we will see is where to invest money. Should I invest in project A or B? I will teach you how to make better investment decisions with your finances that you have. I will teach you to invest money in the right project, in the right place, right? I will also teach you how to get money or how to raise finance or raise funds, right? Again, first things first, the first step is where will we get the money from? How do you think you can get money for your company, Harshika? No, where will you get the money from? So probably you can get investments from people. So maybe you can raise money through people investing money, right? These are people, they invest money into your company. So basically, they are shareholders who are putting in money. That is equity. Equity, right? The other place you can get money from, again, if nobody is investing in your company, what you can also do as an alternative. Yes, Yashika, that's absolutely right. You can go to a bank and say, look, I want to start a business, give me a loan. So the other place of getting money is a bank loan or a debt, as Yashika mentioned. So basically, what we need to understand here is I will first teach you how to raise finance, where to raise finance from, how to raise finance. Again, you can take a loan, which is a debt, or you can take investments from shareholders, equity. So these are two ways, at least for now, you can get money from. Again, in this paper, I'll teach you in detail how do you raise finance. Once you have the money, you want to use it properly. You want to invest it properly, right? You want to put it in the right places, right? Project A will get you 100 crores in profits, and project B will get you 80 crores in profits. Where do you invest? A or B? A, common sense. So I will teach you which project is a better investment. Now, obviously, once we get to the sums, it's not going to be so simple. But I will be teaching you how to invest, how to make investment decisions, where to invest, both short term and long term. And once you have invested, guys, once you have invested, you want what? Returns. You want profits. So I will teach you how to treat those profits. How much of those profits you should give to shareholders? How much of it you should retain it? So I will also teach you about dividends and how much and how to allocate the profits to the shareholders. Okay. For example, Anjana, you are a shareholder. Would you want the profits from the company? Yes. Yes. So you want, I will teach you how the company will allocate the profits to the various shareholders. And this is the basic introduction to financial management. Basically, we are basically learning how to manage our finances. How do we get finances? how do we get finances, how do we invest, and what do we do with the profits. This is broadly what you are looking in the FM paper. Right? These are the things that you are broadly looking at in the FM paper, with which the introduction to financial management is done. Once something is done, I will mark it in green, meaning it is done, over. Okay, so again, if you want, you can make a note of this, because everything I'm writing is from the text. So there's nothing missed out of the text. There's nothing I'm doing on my own. So you can make notes. You should, in fact, make notes. Okay. Now, what we're going to look at is, again, we're going to look at financing decisions, dividend decisions in a lot more detail. But here we're going to look at management accounting and financial accounting. And I'm basically briefing you on what is MA. How many of you wrote your MA paper? Anybody here wrote your MA paper? MA, FA papers, anybody wrote? F2, F3?
Exempted paper for us, but we have written in the college exam.
You wrote it in the college exam. Okay. So, again, what does the management accountant do? Now, again, guys, when you do ACCA, you are basically doing professional accounting. ACCA is a professional accounting qualification, right? And under ACCA, there are so many areas where you can specialize in. You can specialize in management accounting, you can specialize in financial accounting, you can specialize in audit and assurance, you can work in financial management. Now, again, I just briefly mentioned what will you do in financial management. You're basically managing finances. You're looking at how to raise finance, how to invest finance, and how do you treat the dividends or the profits. But now, in this section of the textbook, we're comparing financial management with management accounting and financial accounting. Okay, what does management accounting do? Management accountant is the one who is working with the management in running the day-to-day functions of the organization. These professionals work closely with the management. That's why the name is management accounting. They work closely with the management in running the day-to-day functions of the organization. For example, suppose, guys, I sell a hat. Okay, this is a hat. This is a hat. Now, if I add 2 circles under this, it will become a car. So that is my drawing expertise. But this is a hat, right? Now I want to sell this hat to you people. How much should I sell it for? How much should the selling price be of this hat? Any guesses? Hashika? 2 rupees. 250. Hashika says I should sell this hat for 250. What does Arisha say? How much should I sell this hat for? Arisha says 150. Kenny, what do you say? Shivaji says 500. Very good, Shivaji. Okay, let's go with Shivaji's selling price. Shivaji says 500. But this hat is a very, very expensive hat. I mean, it was made with some very expensive material. It is gold plated. right? There is gold in the hat. So the cost of the hat, to make the hat itself, it costed me 4,000 rupees. To make the hat itself, it costed me 4,000 rupees. Look at what I'm highlighting in blue. To make the hat itself, it costed me 4,000. Now, Harisha, tell me how much should I sell this hat for? So now tell me, guys, how much should I sell this hat for, Harisha? How much? Now Harisha says 5,000 you should sell it for.
5,000.
Shivaji, how much should you sell this hat for now? Maybe Shivaji will say 10,000 now. So again, I don't know if you people are realizing, but you need to know the cost of the product or service that you are selling. Yes or no? Without that, as Arisha has highlighted in the chat, we will be in a loss. There is a danger that we will sell at a price lesser than the cost, meaning we will be at a loss. So, what is it important for us to do? It is important for us to know the cost of what we are selling, correct? Who will determine the cost? Who will sit and calculate the cost? It is the management accountant who will sit and determine the cost. So the management accountant will determine the cost. So the first job, I hope with this example it is clear that the first job of the management accountant is to do costing, to determine the cost. Management accountant will do this. After determining the cost, okay, the hat is 5,000 rupees. Now again, I want everybody to tell me how much should I sell the hat for. The hat costed us 5,000 rupees. So how much should we sell this hat for? 5K. Yashika says 10,000. Everybody fast, quickly, quick. Pick up. 15,000. Arisha, 6,000. Everybody fast. Nitesh, 8,500. Shivaji, where did you go? You sold the hat once for 5,000 and left. Jigyasa says 12,000. As you can see in your day-to-day business operations, you will have to make a lot of operational decisions, such as how much to sell the hat for. That decision making is done by the management accountant. How much should I sell the hat for? How many people do I need to hire? Who will do what? As I said, these are people who are working very closely with management. Then after that, what happens? Let's I'll give you an analogy. But if you are going on a trip, say, make it easier. If you are going for a movie, will you sit and make a proper budget? Make a budget. Okay, fine. 180 rupees I need for the movie. For the movie ticket, 180 rupees. Again, in Chennai, it costs 180 roughly. I don't know about other cities. Okay. Unfortunately, food costs more nowadays. It is almost as much as the movie ticket. So food, you'll spend 200. What else? What other expenses will you have? Travel, maybe if you have a car or something, maybe petrol. Or if you don't have a car, then for Uber you need. What other expenses do you think you will incur? So you are sitting and making a plan for your movie. 180 rupees for the ticket, 200 rupees for the food, 100 rupees for the travel. What else? Maybe for emergency, 50 rupees. So you are sitting and making a plan. You will make a plan. Yes or no? How many of you will make a plan like this for your movie? Manya, Nitesh, Vishakha. You will all make a plan. Janvi says yes. You all will make a plan. Now imagine for a movie, for one person, if you are sitting and making a plan, is it necessary? Is it important for a company to make plans? You for a movie, nobody will remember that movie. No, nobody cares about that movie, honestly. For a movie, you are sitting and making a plan. 180 rupees for ticket, 200 rupees for, popcorn. So for a company, do they need to make a plan ke how much they will spend, how much they will earn? Yes, it is important. That plan is known as a budget. It is a quantitative plan. Okay, this much I will spend, this much I will, use, and so on. Right? So this planning or making of a budget, it is a very important activity as you all are saying. Right? And that planning or budgeting will be done by the management account. Right? So far, the management accountant will do three things: costing, which is basically determining the cost of the product or service; two, decision making, deciding on important management related things; three is making the budget, planning; fourth is this. Imagine now I'm briefing this here, but this will be dealt with in a lot of detail in the PM paper. I don't know how many of you have done PM. Arshika, you've done PM? No. Imagine you plan to lose 4 kgs per month. This is the scenario. Okay, so you work out, you exercise, you work out, etc. You follow a diet. But this month was you had Holi, you have your birthday, you have this, that. So a lot of celebrations come, your friend's birthday, or marriage invitation. So you have to, we can't control it, right? We eat, right? So this month, you lost only 3 kgs. Are you happy? The plan was to lose 4 kgs, but you have lost only 3 kgs, unfortunately. Right? I'm sure a lot of you will be able to relate. So, what will you do? Happy but not satisfied. Yes. So, what will you do in this case? You will, from the coming month onwards, start controlling yourself. Yes or no? Like, for example, when you see food, you will look away. And somebody asks you if you need kulfi, ice cream, you will nod your head side to side, right? You will say no. You will start controlling yourself, right? So, just like how in your individual life, if things go out of plan, you control, correct? Same way in business also, there are times when you will go out of plan. So what will the company do? The company will look at ways to bring themselves back on track by controlling. Now, again, this is something that is done in a lot more detail in the PM paper. How many of you have done PM? PM, PM, performance management. Yashika, you know what I'm talking about when I'm talking about this going out of control, bringing it in control. Manya, are you understanding which topic am I relating to? You go out of plan, there is a difference, right? There's a variance.
Standard costing.
Yes, after that you do variance analysis. But again, anyway, you don't need to look at that in a lot of detail. But businesses also make plans. You'll do, who will make the plan? The management accountant. Once he makes the plan, we have to stick to that plan. But sometimes our plan will go out of control. So we have to control also. You will look at this in a lot more detail in the PM paper. But that falls under the job of the management accountant. And that's why the textbook says management accountant is concerned with providing information for day-to-day functions of control and decision making. Now, the textbook has put it in a very brief, but management accounting will do costing, will do decision making, will do planning, and will do control. And we are working very closely with the management of the organization in the day-to-day functions of the organization. Versus, what does the financial accountant do? This guy, see guys, management accountant is related to managing the organization, correct? Financial accountant, the company will make a lot of transactions, correct? You will buy, you will sell, you will buy, you will sell. Somebody has to record those transactions in the right place. Yes, Manya, you're right, but it will go in a lot more detail. I mean, there is a lot more you will look at, right? This company will make a lot of transactions, and somebody needs to record these transactions in place. And as Manya mentioned, use those records to ultimately prepare financial statements, which is nothing but a piece of paper. For your level, you can just say it's a piece of paper that has information about the company, financial information about the company. So the financial accountant will be the guy who is recording the transactions and then ultimately using those transactions prepare one piece of paper with financial information about the company. This guy is a financial accountant. So we are providing information about, we record transactions and provide information, financial information about the company by preparing the financial statements. Now, guys, tell me one thing. You know what the management accountant does, and you know what the financial accountant does. Management accountant can be in red, financial accountant can be in black. Tell me how many of you are more interested in management accounting and how many of you are more interested in financial accounting? Harshika? Management accounting. What about others? What do you feel? Arisha is more interested in financial accounting. Anjana, management accounting. Deepika, management accounting. Right? Now there is more information. Oh, yes. They are also differentiating between financial accountant and management. But if I have to differentiate between management accountant and financial accountant, this is what I will do. So, again, guys, as of now, what we have looked at is introduction to financial management, which is basically what? It is basically looking at when it comes to money, when it comes to finances, we need to make sure that we manage them well. We are focusing only on money. We're managing that money. How? By ensuring that we raise it from the right place, by ensuring that we invest it in the right place, and by ensuring that we pay out dividends properly. That is the first thing which is in green. Next thing which is in green is management accounting and financial accounting. So here you've seen in a lot more detail compared to the textbook. I have given more detail in my notes about what the management accountant does and what the financial accountant does. Right? So this is what management accountant and financial accountant does. Once that is over, we will look at the difference between management accounting and financial accounting. Very good, Nitesh. Nitesh is interested in financial accounting. Now, what does management accounting do? Planning. I'll ask you only one question. How many of you have made plans for the past? Has anybody made a plan? Okay, now you are sitting and you are making plan for last year. No? Oh, last year, what I'll do now, today I'm sitting, okay, on 21st of March 2025, and I'm saying in 2005, what I'm planning to do is I will start a company. Does this ever happen online? No. So when it comes to management accounting, it's very less of the past. It looks more at the future. So management accounting looks more at the future. Same goes with decision making also. Think about it. That's another role of management accountant. All of you look at the screen. Under management accountant, I put decision making. Oh, I'm going to make a decision that in 1996, I will buy a car. Is that possible? No. So management accounting, the nature of the work is such that you look more at the future. Are you understanding? So you are more future oriented. But in financial accounting, what happens? I said you record transactions, correct?
It is historical in nature, things about
Yes,
past.
Anjana, that's absolutely right. When you record a transaction, you will record a transaction that has happened. I'll not say, oh, in 2044, I'll buy a car and I'm sitting and recording that. Right? So financial accounting, you record transactions as Anjana mentioned, as Yashika has typed, you are recording past transaction. So again, we're looking at it's more about historical information. It looks more at the past. So financial accounting looks more into the past, and this is there in a lot more detail in the FA paper. Again, even if you got an exemption, this What I'm explaining here was explained in too much detail in FA paper. Another difference between management accounting and financial accounting. I said management accounting does decision making. Now the question is, you want to make good decisions for your own benefit or because the government is forcing you to make good decisions for your own benefit? Nobody is forcing you to make good decisions. There is no law that says you have to make good decisions. In your life, you want to make good decisions for your own benefit. Right? That's why management accounting, this is something that is more that is of internal use. You do it for your benefit, and it is not a legal requirement. You do it for your benefit. You make good decisions for your benefit. It's not a legal requirement. You plan for your benefit. It's not a legal requirement. Okay. Versus financial accounting, preparing financial statements is a legal requirement. Companies are by law expected to prepare financial statements. This is a legal requirement. A lot of external people will look at this, external use, many stakeholders. We will look at this in this chapter, what are the stakeholders, but many stakeholders will use it. For example, the government, I'll give the examples. The government will use it, the public will use it, the employees will use it. Okay, banks will use it, management will use it, shareholders will use it. They will look at the financial statements. But management accounting, it is for yourself, it is for internal use, and it is not a legal requirement. Now, I gave this example in the yesterday's class. But forget FM. I'll just tell you how I drink my tea. In my tea, I put a lot of sugar, at least 3 to 4 spoons. How many spoons you put, Ashika? Spoons. So I put at least 3 to 4 spoons. I like a very sweet tea. Now, if I make it for myself, I can put as many spoons as I want, right? I can, if I make it for myself, I can follow any recipe. I can follow any format. Recipe, no, I'm not very good with spellings. I can follow any format. If I want 10 spoons of sugar, I can put it. It's my wish, it's for me. But there is a 98 years old grandmother. Can I put 10 spoons of sugar for her and give? No. We have to be kind. Right? I will go and ask her, ma'am, how much sugar will you have? She will say, I don't want sugar, I have diabetes. Maybe. Okay, I'm very happy if she's healthy. But maybe she will say, no need to put sugar in my tea. I will put stevia, the sugar substitute. So when I do something for somebody else, I have to follow their format. I can't do it as I want. This same logic, if we have understood, we can apply it to MA and FA. MA, we're doing it for ourselves. Therefore, there is no specific format that has to be followed. You can do management accounting as you feel right. But when it comes to FA, it is used by so many people external. There is an external use. Therefore, FA is like this grandmother. I can't prepare financial statements based on my mood or based on my wish. Financial accounting, there is a format that I have to follow. So, management accounting, from this example, I hope it's clear. Management accounting, there is no set format. But financial accounting, on the other hand, there is a format to follow. That is, when you prepare financial statements, I'm sure all of you have done basic preparing of financial statements in school, in college, somewhere you would have seen, maybe in the FA paper. But there is a specific format to follow. You cannot do it as you want, as you wish. Right? So these are broadly the main differences between management accounting and financial accounting. So we've broadly looked at what is financial management, what is management accounting, what is financial accounting. So basically what I've done in these 35 minutes is given you a basic on 3 papers of ACCA. I've talked about MA, which is one paper. I've talked about FA, which is another paper. And I've talked about FM, which is the paper that you're doing now. Right? But again, going back to the introduction to financial management, we are learning how to what? We are learning how to manage finances. Where do you raise it from? Where do you invest? And how do you deal with dividends? Then I told you the difference between management accounting. This is, sorry, not the difference. I told you what is management accounting. It is in red. And then I told you what is financial accounting, which is in black, which was the second point. Then I gave you 3 differences between management accounting and financial accounting. Right? Now, what we're going to do is again come back to these things. But the most important thing that we need to understand before we look at anything in FM is we're managing finance, correct? But we are managing finance with some objective. In the company, yes, we are trying to, as I said, we are trying to look at how to raise funds, how to invest funds, and what to do with dividends. But ultimately, the main objective is what? Why are we running an organization? For what? For time pass? Ultimately, the objective is wealth maximization. Ultimately, we're doing all this. We want, there is this one guy who is sitting here. This guy is there. Okay. He has horns also. What we he is our boss. He's our owner. Ultimately, we exist to make money for him. We'll make money, give him. We'll make some more money, give him. We want him to become wealthier and richer. So our ultimate objective is what? Wealth maximization for the shareholder. We want to make the shareholder more wealthy. So our ultimate objective is shareholder wealth maximization, which simply says that we are working to make the shareholder wealthier and wealthier. This is, I feel, the major objective, the major prime financial objective, or the prime objective. I'm putting it in the bracket and saying that this is the prime objective, right? But there are some other objectives as well. Like, for example, you are all studying with, you are all here in Finchartered Academy, right? We want to also make sure that we are growing. So growth is another objective. We want to expand. We want to have, we have students from various cities, Hyderabad, Mumbai, Delhi, even other countries also. Like even now, these online students are in various countries and cities. In India, various cities. And then there are people who are in different countries, not in India. Okay. So what I want to do is, yes, wealth maximization is there, but we also want to grow. And we want, another objective is we have social responsibility, which you don't need to worry about too much right now. This is also our objective. We want to make sure that we are socially responsible. We are giving back to the society, but all that we will look at later. Right? So these are the objectives, but the prime objective is what? Shareholder wealth maximization. So I'll make the shareholder go now. Right? Now in this box, we have in more detail what is shareholder wealth maximization and all that. Right? Now I will tell you what is stakeholder objectives and conflict and who is a stakeholder. Many people, in fact, even working professionals feel that shareholder is equal to stakeholder. They feel this, but it is not true. Remember, shareholder is not equal to, not always. It's not necessary that all shareholders are, yes, all shareholders are stakeholders, but it's not necessary that all stakeholders are shareholders. Many people use these terms interchangeably. Interchangeably means they think it's the same thing, but it is not. Stakeholder, I'll just explain this to you in one word. Stakeholder is anybody. Anybody, stakeholder. Shareholder is the owner. Is it the same anybody and owner? Is it the same anybody and owner is the same thing? No. Stakeholder is anybody. Shareholder is the owner. Stakeholder is anybody who has an interest in the organization or is affected by the organization. For example, do you think you people are now stakeholders of Finchartered Academy? I said anybody who has an interest or is affected by an organization. So the question is, do you think you are a stakeholder of Finchartered Academy? What do the online students feel? Do you have an interest? Are you affected in any way? Yes. So Anybody who has an interest or is affected by an organization is a stakeholder. But that does not make you a shareholder. Shareholder is owner. You understand? Yes, Arisha, you have student related interests. So you become a stakeholder. Shareholder is owner. So it is not the same thing. Yes, shareholder is a stakeholder. I mean, I am one of the owners of Finchartered. So I'm the shareholder. And obviously, if I am the owner, will I be interested in the company? Obviously, right? So, yes, as a shareholder, I am a stakeholder. But not all stakeholders are shareholders. You people are stakeholders, but you are not owner. So please don't think that it is interchangeable. Don't think it's the same thing. There is some detail that you need to know about it, right? So again, who is a stakeholder? Stakeholder is anybody with an interest or is affected by the organization. For example, you people, students, or say customers are stakeholders. Customers, examples of stakeholders. Who else do you think will have an interest in the company? I want you to use your mind to think who else do you think will be interested in a company? Employees, the staff that work here in Finchartered Academy obviously are interested because they work here, they get a salary. So employees would be stakeholders. Obviously, the management, directors, senior management, who are also employees, but then I'm just highlighting them separately. Aisha, that's absolutely right. Yashika, very good. Obviously, also shareholders. Shareholders would also be stakeholders because as the owner, I am interested in Finchart. Okay, now imagine you people. Now, you people means everybody together. Imagine I took money from you, I borrowed money from you to start a company. I borrowed 10 lakh rupees from you. Will you be interested what I'm doing with your money? Obviously, where am I putting? What am I doing in the business? Am I starting the business and sleeping? You will be interested. So anybody who lends money will, yes, Arisha, you're right. You want me to pay you back. Anybody who lends money to the business will be a stakeholder because he's interested in knowing whether you can pay him back or not. So lenders or banks are also stakeholders. What about investors? Again, if you people invest in Finchartered Academy, you are putting your money in the company. So obviously, if you put money in the company, you are interested in knowing what is happening. What about Prakash? I buy, all these tables that you have in this offline class. Ashika, can you look at these tables? They're nice. Yes. So can we, people who are in Chennai, can we safely ask them to come here? Good place, no? Yes. So I bought these tables from Mr. Mohan. Mohan. Mohan supplied these tables. And every year he will supply the tables. So he is supplying, he is my supplier. Do you think he's interested in Finchartered Academy? Yes, because he is supplying here. If I close Finchartered, where will he supply? He will lose one customer, correct? So supplier is also a stakeholder. Yes, he is making money from me. Supplier is also a stakeholder. What about competitors? Now, again, there are so many other institutes in India. I don't know how many of you studied with institutes before. Have you, Harshika? Yes. So, without naming them, right, let's not name anybody. but without naming them. They are competing with us in providing this service to you. So obviously our competitors want to know what are we doing. In fact, all our competitors now know that one skill level paper, any one we are giving for free. They want to know what we are doing because why are they not minding their own business? Why are they not minding their own business? Yeah, they want to compete with us. They want to do better than us. So they are interested in us. So competitors also, yes, Janvi, that's right. They are interested in you. Finance provider would be the banks, lenders, investors. What about government? It's 3 o'clock. Government also is interested. Government wants to know, are you following the law? Are you following the rules and regulations? Are you spoiling, are you breaking some law? Are you paying taxes? That is the sixth paper, tax. I had that class just 1 hour before your class. So government is interested in that. So all of these are stakeholders. But I've listed the stakeholders and I've told you who a stakeholder is. Mohan can go. Thank you, Mohan. But some of them will be found within the organization. Yes, Nitesh, that's also absolutely right. But we have a good number of examples here on the screen. Some of them will be found within in the organization. For example, the employee. Whenever you come to Finchartered Academy, the staff here, Ashika, you can see in the office there are people sitting and working. There are how many people there? 3 people there working. The employees, the managers. I'm putting them in blue, okay? They are always within the organization. Within the organization, the employees who are there within the organization, I'm highlighting them in blue and I'm putting that they are within the organization. Yes, CEOs, again, senior management. Some of them will be outside the organization. For example, government will not, if you come here in Finchartered Academy office, it will not be like the government officials are sitting here. Will they be sitting here? No, they are outside. Government is outside. Also, again, public will be outside. Public also wants to know if you're following all the rules, if you're spoiling the society, if you're damaging the society. Public is also interested. But public and government, these are people who will never be found inside Finchartered Academy. They will be outside. So these people are outside the organization. In red, I'm marking them. The people who are outside the organization are in red. Then in green, or rather, let me change the color. In black are those people who are outside, but every now and then they are getting in contact with us. For example, customer. Okay, let's assume the student is the customer. You are outside, but every now and then you will come. Imagine the customer of a supermarket. Customer will be outside, but every day, every week, he will go and buy. He will get connected. Right? So the people I've marked in black are people who are outside, but will regularly get connected with the organization. Right? Now it looks like a flag, blue, red, black. But there are these people who are outside but will regularly get connected. For example, shareholder, the owner, customer, yes, Nitish, customer, shareholder or owner, he will be outside, but every now and then he will come and he will take his profits. Lender or bank also will be outside, but every now and then what will we do? We will repay him with interest. Right? Supplier, Mohan. See, Mohan went now. Mohan was there before some time. Then I said Mohan is going. Now again Mohan is back. Mohan is back and he's again supplying to me. So he is again getting. So again, Mohan, Harshika is here, guys. Actually, there were supposed to be three people offline, but there's one today. Harshika. Harshika, where is Mohan? Is Mohan here? Mohan is not here, but Mohan will every now and then get connected with us. He will keep coming. Right? So these people are outside but will regularly get connected with the organization. And I've marked it properly. The ones who are blue, they are within the organization, and for that reason are known as internal stakeholders. Because they are within the organization, in internal. Right? And I've marked the examples in blue, employees and senior management. Those people who are outside government and public, these are external, they are outside, so they are external stakeholders. And the ones who are marked in black, they are outside but will regularly get connected with us, regularly get in contact with us. They are connected stakeholders. Examples are there in black: customers, shareholders, lenders, suppliers, competitors. And that is what the textbook is talking about. It talks about who a stakeholder is, along with the different categories of stakeholder. Again, the textbook hasn't explained it in too much detail, but I have. So we've looked at who the stakeholder is. Next, before we move on to the next topic, what I have decided is this. Today's class timing is still when? Harshika says 2 to 5. I hope online people know this. How many of you are not in India? I mean, you need not mention where you are, but how many of you are not in India? Arisha is not in India. Anybody else who is not in India? Osama, Shivaji. Okay, so we have three people who are not in India, but we are going with Indian time. What I have thought of is in ordered half an hour difference from IST. So yes, I think I know which country you are, right? So again, what was I saying? Yeah, I've decided that in order to finish the syllabus, I will take class till 10 p.m. today. Ashika, unfortunately, you will have to call up your house and mention to them that the class is till 10. Ashika, okay? Okay, sure. What happened? You don't mind? 2 to 10, no problem. If everybody is okay, guys, she needs your help. Deepika is more than happy, okay? What about others? Shivaji is happy. Arisha feels it's a very long class. So Arisha, oh yes. Yashika says no. Anjana also says no. So as unfortunately, the ones who are creating problem for me are Yashika and Anjana. Deepika, I'm very happy. She's more than happy to attend class. But Yashika and Anjana, you gave confidence to Harshika over here. After seeing your no, she got very happy. Harshika, there are people in your support, right? As you can see, there is a disagreement or a kind of a conflict between me. I'm telling we'll do it 2 to 10. You're telling no. There's a conflict between me and you, who are basically the various stakeholders of Finchartered, between the stakeholders of the organization. This situation, when there is a disagreement or conflict between the various stakeholders of an organization, is known as what? It is known as stakeholder conflict. So, guys, we are leaving by 5. Don't worry, it was just an example, right? So, stakeholder conflict is what? Stakeholder conflict is basically where there is a disagreement, a dispute, a conflict between the various stakeholders of an organization. Yes, right. Sometimes I have to do these kind of things to wake people up, right? So the happiest is Harshika, but Harshika, you can go. Right. So here we're looking at what are the various conflicts that could arise. Again, what I've explained here is mentioned conflict of stakeholders and all that. And one example in the textbook is there could be a conflict between various people. There could be a conflict between employees and shareholders. For example, employees want more salary, but shareholders don't want to give high salary, because if they give high salary, they'll get less profit. Okay. Customers and management. Right. So what management wants to do is, yes, price of the product. You know, we want to increase the price, but customers don't want the price to increase. So there could be various conflicts between the various stakeholders of an organization. See, wherever there are people, you should expect conflict. There is a very high chance that there will be conflict. Now, again, guys, what time is the break? Because I've put this on myself. I've told my team that if I don't follow the rules strictly in our office group, you have to tell me that you are not following the rules. So 3:25 is our break. Okay, in 13 minutes. Whoever does not want me to fall in trouble, please remind me at 3:25. Sharp 3:25, we will take a break exactly for 10 minutes. So the rule is 10 minutes exactly. Yes, I do. I enjoy teaching. So 10 minutes exactly. The break is not supposed to cross 10 minutes, and the break is not supposed to be less than 10 minutes. Okay. Now we're going to look at agency theory. Guys, how many of you have been in a situation where you have done a friend's homework, or vice versa? Your friend has done homework for you. How many of you have been in a situation like this? Harisha, have you been in a situation like this? You did the homework or somebody else did your homework? You did the homework. Okay. What about others? Have you been in a situation like this? Somebody did your homework, Harisha. Very good. Yashika, both circumstances you've been in. But let's take Harshika's example. Okay, Harshika did somebody's homework. homework. So here, as you can see, Harshika is performing a task for somebody, on behalf of somebody. On behalf of somebody. Whose homework did you do? Your friend. The friend's letter name starts with which letter? Meera. Meera's homework you did. Meera is coming here? Okay, great. So we'll ask Meera why she did not do her homework. Okay. So Meera will be here on, when is our next class? Monday? So we will ask Meera. Meera was the one whose homework or whose work was done. Here, Harshika, the one who is doing work on behalf of somebody else, is the agent. So Meera has agents who will do her homework for her. And Meera is known as the principal. Right? This relationship between people where one person does work on behalf of another person is agency. One party does tasks on behalf of another party. This is agency. This relationship is agency. So, Harshika, you are in an agency relationship with Meera. You have to tell her this. No, you told her. You will tell her. Right? This is an agency where who is the agent? You. The one doing the work on behalf of the other person is the agent. And who is the principal? The one relaxing and getting the work done. Now, the textbook mentions that there could be a problem with agency. So we've looked at what is agency, who is the agent, and who is the principal. Agent is the one doing work on behalf, doing the work, and principal is the one who is getting the work done. And the problem, as mentioned in the textbook, is the agency problem. I don't know if it's there in too much detail, but yes, it is there. And there is a divorce also that is happening. Okay. So, what is this problem? The problem is this. The other day, I'll give you another example, an analogy to explain what is agency and what is the agency problem. The other day, I wanted some cold drink. There was Coca-Cola, and I wanted some Coke. So I asked my brother to get me one glass. I was relaxing. And there was very little Coca-Cola left. So here what is happening is the agent is my brother because he is supposed to get the Coca-Cola on my behalf. And the principal is me. And there is an agency, small agency relationship between us where he is doing work on my behalf. To my surprise, for a very long time, he had not come. I'm waiting. I was on Instagram scrolling and waiting. Yes, Nitesh, that's right. I was waiting, and then I went outside, outside my bedroom. And to my surprise, I see empty Coca-Cola bottle. And I see my brother drinking it. The last, whatever is there. So basically, He was supposed to work in my interest, correct? But when the agent stops working in the interest of the principal and starts working in his own interest, that problem is agency problem. So agency problem is where the agent stops working in the interest of the principal and starts working in his own interest. That problem is agency problem. Now, how does this apply to your FM paper? Remember, guys, the real boss of the company is the shareholder or the investor. Shareholder, they invested money, so they are the owners. But they don't run the company. 5 minutes. Yeah. They don't run the company. They hire people to run the company who are known as the directors. So here there is an agency relationship between these two. Now, I would hate to do this, but there is an agency relationship between the shareholder and the director, where the agent is the who? Who is the agent? Director, yes. And the principal is the shareholder. So the director is supposed to work in the best interest of the shareholder. But when that stops and the director starts working in his own interest, that problem is agency problem. Okay, so that is how these examples of my brother and me and Harshika and Meera, that is how it relates to the textbook. Right? So you see the principal appoints the employee. You can just look at this chart. The principal employs the agent to run the company on behalf of the principal. Right? Now, again, they've used an interesting word, divorce of ownership and control. I'll just explain. We will make them get divorced and we will go for the break. Divorce. I'll just leave it at divorce because when it is seen in the LMS, when you see divorce, people will get curious. What is it? Who is getting divorced? Right? But here, what is happening is, see, again, I have to draw the same drawing, but the company is there. For whatever reason, this square, whenever I draw, please assume that it is a company. Okay. Outside, who is sitting? The shareholder. And inside, who is sitting? The director. The director is controlling the company, and the shareholder is owning the company. Now, the thing is, the person who is owning the company has been the person who controls the company is not the same as the person who owns the company. There is a separation between them. The one controlling the company and the one owning the company are separate. That's why we are saying using the word divorce. It's not really a divorce. Right? But the separation between the ownership and control, where the people who run the company are not the same as the ones who own the company, and vice versa. The people who own the company don't run and control the company. This is divorce or separation of ownership and control. We can just, for the next 2 minutes, read what is there. Shareholders are reliant upon the management to run the company on their behalf. Shareholders can intervene. Yes, they can interfere, but they don't get themselves involved in the day-to-day operations of the business. And management, they are the ones who are actually in control. They are uniquely placed to make decisions. Things are in their hands. Things are in their control. Right? So that is what we mean by the divorce of ownership and control. Right? Again, I did explain this because I have only 1 minute. managers can be seen as agents. I did explain this, of the shareholders, right? And under the managers, whoever work will be the agents of the managers. And it keeps going. If the problem, the agency problem, look at what I'm highlighting. The agency problem is where the agent starts working in their own interests. That problem would be known as the agency problem. Okay? I hope this box is clear. I hope the agency theory and all of that is clear. And with that, as you can see on my screen, it is 3:25, meaning that you can now finally take a break, right? 3:35, we will not start before and we will not start after. Exactly 3:35, we will restart. Okay, don't leave the meeting, just stay in the meeting, but you can do whatever you want. Yes, guys, it is sharp 3:35 Indian time. So let's get started. Come back. Can you all just confirm that you are back? You are here. Yes. Okay. You just give me 1 minute. Some issue with my charger. Lose connection. It is for June attempt. So we have like 9 hours of class every week. Is to ensure that you are writing as soon as possible. Okay, so just have a look at these things which we are going through. Great. So let's continue with remuneration, empire building, creative accounting, all of these things we will look at. Okay. But see, one way to ensure that there is no agency problem is by rewarding management. See, if you don't reward them, they will start working in their own benefit. But what you should do is you should make a reward system that rewards them if they achieve your goals. So, for example, in my brother's case, if I would have told him that if you get me that Coca-Cola, I will order a brownie for you. I am 200% that Coca-Cola would come to me within 2 minutes. Right? So you need to have proper schemes that reward management to ensure that, I mean, those schemes are there in a way and in order to ensure that management works in the best interest of the shareholders, right? So yes, that is what this is basically talking about. right? So one way to help ensure that managers take decisions which are consistent with the objectives of shareholders is to introduce carefully designed benefit packages, remuneration packages. Benefit remuneration is paid, but again, make sure that they are rewarded for what they do, right? Now that these are these schemes. Now, what are the types of schemes? Share options and so on. Again, I will brief you on this going forward. But for now, you just need to know what is and why is it necessary to reward management. Basically, the agents. As I said, I will look at this in more detail. This box we will cover. But not now. Why not now? Because too much theory puts ourselves, our students to sleep. So what we will do is we will quickly finish this chapter, move to the next, and there's actually a lot actually. Right, so there's a lot of theory, and I would want to finish this and move to numbers, and then once you are a little bit more, your brain is back, we will go back to these things. Now, here we're just introducing you to what is corporate governance. And I will show you an example, a YouTube video. I mean, it's not made by me or anything of that sort, but just it's a random YouTube video. So I'll just show you that.
The biggest lie in the world of stock markets is volume. You've been using it all wrong. Let me tell you how it works. Volume is nothing but the number of transactions and
shares and prices kept.
Okay, so we will look at volume later. But for now, let's just make sure that we watch this recording. Okay?
Enron used to be the 7th largest corporation in the United States.
Online people, you're able to hear what this video is saying? Can you hear? Is it audible? Okay. So we're talking about Enron, okay?
States, at one point, valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down.
So what they're doing is basically they're hiding the truth. What do I mean by hiding the truth? There was a lot of issues that were going on in the company, but they decided not to tell the truth.
Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued.
So they were hiding the truth for a very long time, but then obviously people started doubting that maybe this company is overvalued.
This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001. In December 2001, Enron ultimately filed for bankruptcy.
So again, what happened was, wait, I don't realize why I'm translating, but just to make sure that you are clear on this company ultimately went bankrupt.
Approximately 20,000 jobs and $2 billion in employee retirement funds were
So much to lose.
lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. Enron was an early example of just how recklessly some corporations are managed. We then had was an early example of just how recklessly some corporations are managed. Enron was an early example of just how recklessly some corporations
Why
are
did I
managed.
replay that so many times? Is because it says that because this corporate was governed wrongly, this corporate was not run or managed properly, this company ultimately went into disaster mode. So this sentence tells you that, yes, decision-making issues, basically overall management, company management, how the company is run, how the company is governed, it is very important. And that
We then had countless other examples.
is what corporate governance is about. Corporate governance is basically a set of policies by which a company is run, administered, or governed, managed basically. We need proper set of policies, a set, and this is something you learn in AA. How many of you cleared AA? A set of policies by which a company is run, managed, administered, governed, whatever it is. How a corporate, a set of policies by which a corporate is governed, and that's where the name comes from, corporate governance. You're taking AA in June as well, okay? So you will learn about corporate governance in AA in a lot more detail. Wait, AA? Yeah, AA also we see corporate governance. Result awaited for AA. All the best, Rama. Okay. So what is corporate governance? Corporate governance is a set of policies by which a company is run, administered, governed, basically. And why are we looking about all of this? Why are we looking at all of this? Again, there's just a mention of NEDs and EDs, so I'll not like take too much time because again, there's too much theory and I don't want to like kind of bring down your attention with too much talking. But we said that corporate governance is a set of policy by which companies are governed or administered. We don't want anybody to mismanage the company. As Anisha said, poor decision making. We don't want that to happen. Again, in AA, you will learn about this in more detail. You will learn about audit committee. You will learn about nomination committee, remuneration committee, right? And I'm sure, Osama, you would have learned about, if the client does not support you or give you all the information that you need, you will raise it to those charged with governance. So governance is basically it's basically how you manage the company without mismanaging it, without doing fraud. And that's why we have directors, but we have two types of directors. The directors who do means what? Who execute the day-to-day running of the organization, who do the day-to-day running of the organization. Okay. And then you have those directors who don't do. Non-executive. Execute in English means to do. Execute this means do this. Those directors who don't do, who don't do the day-to-day running of the organization. Those who do are the executive directors. And those who don't do are the non-executive directors. But what do the non-executive directors do? They watch over the actions of the executive directors. The non-executive directors watch the executive directors to ensure that they are managing and running the organization well. That's why it is important to have NEDs on the board. And obviously, they have to watch over the actions of the executive directors. So they need to spend a decent amount of time doing that. Again, those things are very, very basic things. So you can make a note of it. And obviously, guys, in your exam invigilation, when somebody comes and watches you, does your friend come and invigilate you? In your ACCA exam, does your friend come and invigilate? No. It will be somebody who is independent of you. Independent of you means somebody who will not be like coming and supporting you. Or somebody who is writing the exam with you. No, it will be somebody independent. It will be somebody who is completely unbiased. Same way, non-executive directors are watching over the actions of the executive directors. Therefore, NEDs must be independent. And at least half of the board should be NEDs so that they can watch over the actions of the executive directors. Right. Another thing, which again, that is what it is with non-executive directors. But now, what is corporate governance again? Corporate governance is a set of policies by which we run, manage the organization, and we don't want the organization to be mismanaged, correct? So, imagine if, say, in your what example can I give for this? Okay, imagine you have one monitor in class and one class rep. Okay, class rep's job is to represent the class in all important matters related to activities, academic and non-academic. Class monitor's job is to watch and check if anybody is doing anything wrong. Right? So there is one person who is monitoring the class and the other who is going and representing the class in important activities. Now, both these positions are positions of some power, correct? Representative also has power. Monitor also will monitor you and complain about you. So he has power, right? Now, if it is two people, it is good. If monitor and rep is one single person, if monitor and rep is one single person, what will happen? Monitor and class rep is one single person. Yes, there is workload. What else? See, monitor is also powerful. Class rep is also powerful. But if one person has both the powers, don't you think he will become too powerful? So if monitor and class rep is one single person, yes, wrong use of power. One single person will become too powerful and he will be able to do what? Anything as per his wish, which we don't want in corporate governance. In corporate governance, we want to ensure that the company is managed properly in such a way that nobody is mismanaging, nobody is misusing power. And that is why it says under corporate governance that the chairman and the CEO should be two different people. We don't want the class rep and the monitor to become the same person, because otherwise there will be too much power in the hands of one person. Right? So that is why in executive directors, we said that using this example, rep and monitor, we are saying that the chairman is also a powerful person in an organization. The CEO is also a powerful person. So what we're saying is they should not be the same person. That is why it says separation of chairman and CEO, and they always get re-elected. And as I mentioned, we need to reward them for their performance, and we need to clearly mention what are the rewards. Right now, again, we have elaborated on that in more detail in this box. Right. Now, guys, I will not do this here because the textbook says this specifics will be explained in chapter 19 of FM. So I'm going to not do this here. We will look at this in chapter 19 itself, because again, I want to close up on the theory part and go to sums so that it's not too dry for you. Okay. Objective setting in not-for-profit organizations. Guys, again, first of all, what are not-for-profit organizations? As the name suggests, okay, here in Chennai, okay, I don't know, Aisha, right? Harshika, right? Harshika, do you know there was a restaurant called Dialogue in the Dark in Express Avenue? You know Express Avenue, right? The mall. Right. So here there was a restaurant, again, guys, a little out of the topic, whose main objective is social welfare. Very good, Asama. That's absolutely right. Okay. Again, there was a restaurant called Dialogue in the Dark. Okay. And the theme of that restaurant is when you go there, you eat in the dark. There are no lights. I mean, maybe little bit lights are there, but you have to eat in the dark. Right. Now, speaking of restaurant, I don't know, I'm feeling like I'm not eating now until the evening. I'm not supposed to be eating. And I've been speaking nonstop from 6 hours. So automatically restaurant is making me a little uncomfortable. But you are supposed to eat in the dark. So you would think, oh, why will anybody go and eat in the dark? Maybe it is a different experience. You know, you go and sit in the dark and eat. Right? But when you actually go there, you will see that the people there, like the waiter and all that, they're all blind, they're all visually impaired people, visually challenged people, right? So after going there, I got to know, and I have nothing to do with this restaurant, I'm not promoting it, right? So after going there, I got to know that first of all, the restaurant gives jobs to these people. Number one. Number two is with the money that they make, they treat these people. And three, when people who can see, right, when they go and eat one meal in the dark, you also realize their struggles, right? So it also helps people realize the struggles, their struggles. So this organization was run not to make money. This organization was run not to make money, but for some other objective, maybe benefiting. So, Asama, yes, your definition was right, but I just wanted to give this example. So, not-for-profit organization is those organizations that don't exist for profits, but
It's 4 o'clock.
other reason, right? Examples are charities. Examples are restaurants like this, which I mentioned, NGO. Examples could be hospitals. Now, the minute I say hospitals, people start smiling. When I say hospitals are not for profit, right? Again, we're talking about government hospitals, right? So here we're assuming that they are not working for profits. Now, again, education sector, Nitesh, again, when I say education, schools, people again start smiling, right? But again, we're talking about, say, government schools, where the objective is to give quality education without charging, right? So these are examples of not-for-profit organizations. Now, what are the challenges of not-for-profit organizations? So we've looked at what are not-for-profit organizations. Now we're looking at challenges of NFPs. What are the challenges of looking at the objective? See, objective for a for-profit organization is money. But the objective of not-for-profit organizations is not money. See, for-profit organizations, it's simple. The main objective, see, whether you want to give high quality, whether you want your customers to be happy, ultimately the objective is money. But not-for-profit organizations, their objective is not profits. So obviously they have many other objectives. For example, healthcare. Oops, where did that go? Guys, just give me 1 second. My desktop is not the best. Yeah. Okay, so as I was saying, not-for-profit organizations, they have multiple objectives, right? For example, for a hospital, what would be the objective of a hospital? To treat patients. What is happening? To treat patients, right? To spread awareness about diseases. Right? The other day I had come to your college, you remember? No. So when they were talking Red Cross, something, they were talking about AIDS. Do you remember that? So I was the chief guest. I don't know how do we not remember? But again, you are also spreading what? awareness about diseases, right? So they have multiple objectives. Again, another objective is giving quality, but at the same time, handling patients. I mean, just, think about it. I have to give you quality also, but I have to be fast also and handle all patients also. So they have multiple objectives, and that is what it talks about. And objectives aren't easily quantified. For example, for profit organizations, it is easy. Okay, this is the profit, this is the number quantified. But how will you quantify objectives for a hospital? You will say, oh, number of patients cured. Say if the number is high, performance is good. But what if everybody is in coma? I mean, yes, you're curing them, but they're obviously not leaving the hospital. So how do you measure? They're all in coma, nobody is leaving. Many types of patients are cured by MD. MD, who is MD? Okay, so again, what I'm trying to tell you here is it is not as easy to measure the outcome as it is for for-profit organizations. Again, for-profit organizations, it is easy, it is comparatively easy to measure outcomes and map them, align them with the objectives. But for not-for-profit organizations, it is comparatively harder. You're not understanding? Because there are so many objectives, different objectives, and it's not easy to quantify. There is no set number. Difficulty in quantifying it. For example, for the police department, they are not for profit, correct? How will you measure their performance? Okay, doctor in medicine. Number of people, number of cases solved. But again, many cases run for years and we are working towards it. So how do you measure that? Many cases in a lot of countries run for years, right? So how do you measure an ongoing case? How do you know how have we performed? So it's comparatively harder. That's what we are trying to say in the text. Okay. So not-for-profit organizations, what they are is looked at. Okay. Now, finally, I think this is the last thing, value for money, after which this chapter is over. But this is something that I really like because value for money is 3 E's that you need to know. See, when you are an organization, you need to give value for money, and it has 3 E's: economy, efficiency, and effectiveness. And I think people who have wrote AA, PM, I mean, this comes in so many papers. Effectiveness. So what is value for money? Value for money has 3 E's. And let's take the example of, I'll take one example. let's take the example of this thing. This is heat, and this is used to kill mosquitoes, right? Now, when will you say that, oh, it was economical? No, no. When will you say that, oh, economical? Okay, let me change the question. Economy class ticket. What do you mean by it? It is economy means what? Economy is minimized cost. When will you say something is economical? Is when you minimized the cost. That is when something is economical. So again, coming back to this hit, when will you say it is economical is when you get it at a minimal cost, minimized cost. Don't use the word cheap. It's just a fair minimized cost, lower cost, yes. That is economy. Next is, when will I say this was effective? Hit, when will you say it was effective? When it kills all who? Don't stop at kills all. It becomes very misleading. Kills all means who do you want to kill? It kills all the mosquitoes, right? So effective is basically when the objective has been met. Okay. The main objective, were we able to achieve the objective? For example, another example would be when will you say Panadol is effective? Now, this is a paracetamol. You want to call it Dolo, you want to call it whatever. When will you say this is effective? When your headache is gone, right? So effective means when the objective was met. When the objective is fulfilled, when it treats your issue, whatever your issue was, headache, cough, cold, whatever it is. Right? And what is efficiency? Effective looks at, have we achieved the objective? Efficiency, now again, going back to HIT. Now, efficiency will be, you want to spray little, your output, again, what you're putting out, basically your input, what you are putting in, you want less. But the result, you want more. So you want to spray little, but you want everybody dead, mosquitoes, right? So the object, when will you say something is efficient? Efficient is input is less, output is more. You understand? So when will you say the class was effective? You will say class was effective when you understood everything and you passed. So the objective was met. When will you say the teacher was efficient? Is maybe in little explanation, you are able to understand everything. Right? Yes. Again, Manya, it is basically you want the best output. Again, time and money is your input. So you want less input and more output. That is what is efficient. Efficient looks at output to input. right? So what is economy? Economy is whatever you're doing, you do it at, deliver at minimal cost. Effective is the objective is achieved. The output is achieved. Efficient is where your output is less, you want more, sorry, your output is less to come with less output. Okay, sorry. You want to have what? You want to put in less, but you want more result. So you want to give less input, but more output. So it looks at the ratio. So when you are putting in less, but getting out more, you will say it is efficient. Very efficient use of resources means what? You put in less resources, but you got more out of it. Efficient use of resources. So 3 is, again, we're looking at the lowest cost. That's why whoever said cheap, I said that don't use the word cheap, because we're still trying to give the appropriate quality. But it's just that at the lowest possible cost. What is efficiency? Maximizing the output by minimizing the input. If you've understood that, you don't even need to read beyond that. It's very simple. Efficient is what? You put in less, but you get out more. For example, going back to Panadol and paracetamol, you will say it is efficient where half tablet you ate, but your headache was gone. Versus eating 2-4 tablets and nothing is happening. So efficiency is that, and effective is what? You achieve the outcome, the desired result is achieved. So when will you say the headache was effective? Sorry, when will you say Panadol was effective? When the headache was gone. When will you say teacher was effective? When you understood everything and you passed. When will you say hit was effective? When all the mosquitoes died. Right? So effective looks at whether the ultimate outcome was achieved. With which this chapter is over. For example, let's look at test your understanding 3. So we looked at value for money, and now we're looking at test your understanding 3. The agency problem is a driving force behind the growing importance attached to sound corporate governance. Your agents are, who are the agents? Managers. Then talking about test your understanding 2, I said as the financial manager, you have to look at investments, you have to look at raising funds, basically financing, and you have to look at dividends. So which of the following is not one of the 3 main types of decisions? Economic. So, I mean, this is very simple. Okay. Then let's look at, say, test your understanding 5. In the context of managing performance in not-for-profit organizations, which of the following definitions is incorrect? Value for money means providing a service in which it is economic, efficient, and effective. That's right. Economy means doing things cheaply, not spending $2 when the same thing can be bought for $1. Okay. Efficiency means doing things quickly, minimizing the output of time, minimizing the amount of time that is spent on a given activity. Effective means doing the right things, spending funds so as to achieve the organization's objectives. Again, there is, what do you think? Efficiency is what? Efficient. What is efficient? Efficient is less input, more output, minimizing the amount of time that is spent. So I feel efficiency is correct. Minimizing the amount of time to get better result. Doing things well, not quickly. Yashika, you have a point. Efficiency means doing things quickly, but again, less input, more output. So let's see what answers you're able to get. In economy, again, it says you're not spending two, you're spending more. So again, if you have to look at test your understanding 5, efficiency means doing things well. Basically getting the best use of what money is spent on. Again, for the little money that is spent, you're getting out more. Here, what is the confusion is when it comes to B, economy means doing things cheaply. So they've confused you a little bit over here. Because it's not really, you're not supposed to use the word cheap. But then they've given the right explanation. You need to get it done at the lowest cost. Meaning, if something can be done for 1 rupee, why would you spend 2? Right? And effective is to meet the objectives. Right? So answer would be C. With which this chapter is over. Fourteen topics covered. Okay. Finally, we're now looking at numericals. But now what we're going to do in numericals is going to upset a lot of people because this was done in the demo. How many of you did not watch the demo? Type it. Now again, I see one new person. Sadia Parvez was not there before. Guys, make sure that if you are attending it live, you are there from beginning till end. Nitesh was not there. Anjana was not there. Who else was not there? You didn't watch the demo. Mariam Saveer also was not there. Not there as in not in this class. I'm seeing Mariam for the first time. Yeah, demo you watched. But what I was saying that you were not there in the beginning of the class. Anyway, what I'm going to do now is basically do investment appraisal. What do I mean by investment appraisal? See, investment appraisal, we are basically going to learn how to choose which investment is better. See, when you have money, open Facebook, there are some groups where you can type about what business you are doing and people who want to invest will invest. When you have money, you want to invest that money in the best place possible. So that is why you are learning about investment appraisal, where we will teach you how to decide where to put in your money. Right? And in the demo, I had covered ROCE and payback. But unfortunately, Now again, but the difference is this time I will also explain average capital investment. Last time I had not done that in the demo. I'll also do test your understanding too. I had not done that in the demo. So what was done in the demo will be done in more detail here. Again, project 1 gets me a profit of 500 rupees. Same example. Project 1. And project 2 gets me a profit of 600 rupees. Which project will we invest in? Again, the new people type, the ones who are not there in the demo. Where will I invest? Project 1 or 2? Anjana, you are not there. Again, those who are not there, only they have to type. So you people feel that we should invest in project 2 because you're getting more money in project 2. But again, I'll not write anything. Meera is disturbing you. I'll not write anything, but I'll just draw and explain. Finding the cost of each project. Okay. So I'm just drawing and explaining that project 1, you only have to invest one coin, one small coin you invested and you got 500 rupees. Project 2, Anjana, project 2, you invested these many coins. This one big coin, all big coins you are investing. So project 1, you invested one small coin and got 500 rupees. And in project 2, you're investing so much, you're putting in too much capital and getting 600 rupees. Now tell me, Anjana, whoever was not there, I think it was Anjana, Nitesh, tell me where will you invest? Anjana says 1. What about others? Sorry, what about Nitesh? Where will you invest? Osama will invest in 1. Nitesh will invest in 1. So what I'm trying to say is you'll not just look at profit. You will look at the profit on the capital that was invested. See here, you'll not just look at profit and decide. You will not just look at profit and decide. No, you will also have to see this aspect. What was the capital invested? Maybe for project 2, so much capital you are investing and getting only 100 rupees extra. So automatically project 1, as per what you people are saying, is more attractive. So you will not only look at the profit, you will look at the capital that was invested. So you will look at the profit on the capital that was invested, and that. So you're not just looking at the profit or the return, you are looking at the return on the capital that was employed, on the capital that was put in. And that's why this is return on capital employed, right? So first is to just look at returns. Second is to look at returns on the capital that was invested. That is, we are looking at the return and we are comparing it with what was the capital or what was the money that we had invested. Which one will we use to decide which project to invest in, Anjana? First, just returns, or we will look at returns on the capital also. We will take the capital employed also into consideration. Which one? Only returns, or we will look at the returns on the capital? Anjana, Nitesh? 2, right? And that is what return on capital employed is. And if you understood return on capital employed as a concept, you already know the formula. This is the formula. profit or returns divided by the capital that was invested. That is it. With which ROCE is over. So the brief on ROCE is done. Right? ROCE is what? ROCE is the profits before interest and tax divided by the capital that you had initially invested. So again, let's look at a sum. Let's do test your understanding 1. So we're doing ROCE. ROCE is return on capital employed. And obviously the formula is returns or profit before interest and tax divided by the capital invested initially. Initial capital invested. Let's look at test your understanding 1. A project involves the immediate purchase of an item of plant costing 110,000. It would generate annual cash flows of 24,400 for 5 years starting in year 1. The plant purchase would have a scrap value of 10,000 in 5 years' time when the project terminates. Determine the project's ROCE using the initial capital cost. No need to look at average cost. Right? So here, what we will look at is we need only 2 ingredients, just like how when you make coffee, will you take everything? Will you take tomato, potato? You'll take rice also? No, you'll only take what you need. So the 2 ingredients for this is profit before interest and tax. So you need the profit. That's the first ingredient you need. Okay. So here what happens is the question is clearly telling you that the cash flow every year you are getting 24,400. The cash flow is 24,400. From that, you have to deduct expenses to get the profit. You have to deduct expenses to get the profit, but you don't know what is the expenses, so you don't know what is the profit. Yes, Nitesh, that's absolutely right. You don't know what is the expenses, so you don't know the profit. And that's why in the demo, I had explained in brief what is depreciation. And I gave this example exactly, I remember. So again, this part is going to be a little boring because you've done this already, right? But yeah, if you buy a laptop, say for 60,000, will the value of the laptop be 60,000 even after 1 year? No, the value will drop. Why is the value dropping? Because you've used it, no? It's a used laptop. There will be scratches here and there. Maybe it'll be, it'll be a little slow. There was a drop in the value of the asset due to wear and tear. So as you use the asset will get worn out. Yes, Osama, that's right. That is relevant to FR paper, right? The asset will get worn out. Yes, Nitesh, that's right. This wear and tear of an asset is known as depreciation. So instead of saying drop in the value of an asset due to wear and tear, you will make your life easy and you'll just say one word, depreciation. Depreciation is an expense, obviously, because there is a drop in the value. It is costing you your asset. Your asset is going weaker and older. So it's an expense. You understand? So we've looked at what is depreciation. And we look at a baby example before I continue test your understanding one. And the simple example is you buy an item for 100 rupees. And the life of the item is 10 years. So basically the usage, the wear and tear is happening for 10 years, meaning wear and tear is happening for 10 years, meaning depreciation is happening for 10 years. At the end of the life, the item will have no value. There is no scrap value. At the end of the life, the item will be worth 0. So if the wear and tear is happening for 10 years, and if the item is worth 100, 100 is the value of the item. The wear and tear or depreciation is happening for 10 years. So the yearly wear and tear will be 100 divided by 10, which is 10. So the yearly depreciation is 10, which, as Osama mentioned, is done in FR in a lot more detail. So the yearly depreciation is 10. Right? Now suppose I change the question slightly and say, again, it's the same question, but just a small difference. You buy an item for 100. The life of the item is 10 years. At the end of the life, there is still a leftover value. That value is known as scrap value. There is scrap leftover value of 20. So after using the asset, after all the wear and tear, the asset still has a value of 20, meaning from 100, 20 will be left over. So the wear and tear was for 80. Wear and tear happened for 80. 20 rupees is left over after wear and tear. So wear and tear or depreciation was 80. For 10 years, meaning the yearly depreciation is 8. Now let's see if we can do test your understanding one. Again, we just saw that depreciation is an expense. We bought the asset for 110,000. 110,000. Out of which there is a scrap value of 10,000, meaning that is the value at the end of the life after all the depreciation. So 10,000 will not get depreciated. So how much amount is depreciated? The remaining 100,000. This was depreciated over 5 years, as mentioned in the question. So 100,000 over 5 years means the yearly per annum depreciation is 20,000. This is a yearly expense. So the yearly expense we just got to know is 20,000. So if the cash flow is 24,400, in which the expense is 20,000, the profit is 4,400. So we got the profit. That is the first ingredient that we needed. So I have put it there. The second ingredient you needed was the capital, the initial capital invested. How much did we invest in the machine? Initially, 110,000. Remember, the two ingredients was profit before interest and tax divided by capital employed. And the capital that you invested for the machine was 110,000. So the ROCE now you can calculate with these two ingredients. The formula is profit before interest and tax divided by capital employed. Profit is 4,400. Capital employed is 110,000. This we will multiply with 100 to get a percentage. Therefore, the return on capital employed is how much percent? 4%. That's it. Now let's look at test your understanding 2. We have another 10 minutes only, so don't worry. Test your understanding 2. It says, again, we need only 2 ingredients, make your life easy. Profit we need. And we need the capital invested. Again, capital invested, this ingredient is ready-made, it is there, it is 800,000. It is the first ingredient that we have to find. You know, sometimes when you don't get in your ingredients, you will find it in shelves. Same way here, the first ingredient I don't directly have in the question, so I have to find it. Right? What will you do is, you will basically take the average profit per year, because every year the profit is different. First year is 100,000, second year is 200,000, third year is 400,000, fourth year is 400,000, fifth year is 300, 200, 150. This was for 7 years. So how much is the average per year? Add it up, divided by 7. Simple average calculation. How much? 250, are you sure? 400 plus 400. 100 plus 200 plus 400 plus 400. $250, yes. 250 is your average cash flow. So your cash flow is 250,000 per annum. Is 250,000 per annum, and the expense is the depreciation. How much would the depreciation be? Think about it. 800,000. There was a scrap value. 100,000 we will not depreciate, because at the end of the life, still there is a value of 100,000. So that 100,000 is not becoming a victim of wear and tear. So the depreciation was 700,000 for 7 years. So the yearly depreciation will be how much? 100,000. So 700,000 divided by 7 is 100,000. So that is your yearly expense. So your profit would be 150,000. So you got your profit 150,000. You got your second ingredient, which is the capital invested. So 150,000 divided by 800,000 into 100. How much is it? Very good, Nitesh. 18.75. So our calculation was absolutely right. 18.75. So we got the answer. Test your understanding 2 is also done. Now, before I close the class today, I don't know how many of you feel that 3 hours is too long, because generally if in a class, any class for that matter, 3 hours is a very long period of time. So I don't know how many of you are losing your attention. And Ashika has no other choice because she's here in person. But online, I don't know how is the experience. But we have only another 7 minutes left. The other way of calculating ROCE is to get the average capital investment. You'll not take the initial investment. Initial investment in this case was 100,000. Right? But the second way of doing it is instead of taking the initial investment, you are taking the average value of the capital that was invested. What do I mean by that? Initial capital, 110,000. At the end of the life of the asset, there is still scrap value of 10,000. So on the first day, you are 100,000. It's like this. When we started the class, you are like this. Right? Then towards the end at 4:45, when we end the class, again, Harshika is still happy because she has no other choice. She's sitting right in front of me. Towards the end of the class, you are like this. Harshika, see? But on average, how were you? How was the capital? How were you on average? On average, you were like this. So again, using that analogy, what we have to understand is, I'm getting answers already. And I'm sitting and making smileys. Right? So the average is going to be, again, you had the capital of 110,000. At the end of the life, it was 10,000. So the average would be 120,000 for 2 readings. So it is going to be 120 divided by 2 is 60,000. So the average capital value is 60,000. Did you get that correct answer? Yes, 60,000. So the average capital investment over the life of the asset is 60,000. So here what you are doing is going back to the ingredients. Yes, the profit, how much was the profit in this example? So you know, profit was 4,400. I'm not doing the calculation again. But the 2 ingredients you have, profit was 4,400 divided by the average capital investment, which is 60,000 into 100. So 4,400 divided by 60,000 into 100 is how much? 7.33. Let's check if the answer is right. $7.33. So these are 2 ways to calculate what? ROCE. First way, again, first calculation is ROCE is returns PBIT divided by the initial capital invested. We are only taking what was the value of the capital originally, initially. Second ROCE formula is, again, it's still return on capital employed. But this time, what you will do is you will take the PBIT divided by the average capital. Invested. Right? Just look at 15 and 16. Now, always use the first method unless the question asks you to use the second method. So you will always use the first method unless the question asks you to use the second method. So you will always use the initial capital formula unless the question tells you to use the average capital invested formula. Yes. So in PBIT, again, what did I say? How do you depreciate? I've explained, and I've also explained what is initial capital invested. This is simply you're taking the initial profit divided by the initial capital. The other way is to take the average capital, which is 110,000 plus 10,000 divided by 2. And you can implement this in test your understanding 2 to get average capital investment. Right? And it is very easy. Okay, so we can complete the day with test your understanding 2 part B. Again, remember the first part will stay the same. Profit was how much? Average profit? 150, are you sure? Not 250? 150. Profit was 150. And now the capital invested will be, how will you calculate it? Average you will take 800,000 at the start plus 100,000 at the end divided by 2. So 900,000 divided by 2 is 450,000. So here the capital invested is 450,000. So the formula will be, ROCE will be 150,000 divided by 450,000, which is very good, 33.33%. Can we check the answer? %33.33%. And with that, it is 450 now. And as I mentioned, the timetable which we have to follow, these 10 minutes, your job is to go through, to basically review everything and give me your rating out of 5. With your rating, whatever overall feedback you want to put, you can put. But again, it is a 3-hour class. I don't know how the attention span was, but you can let me know how is it 3 hours. Are you able to say it? Is it getting too much on your head? With your rating. So you are free to go through everything and rate your understanding out of 5. 5 means you understood everything perfectly. 0 means I don't know. 0 means you didn't understand anything. And make sure you are on mute. Unless you want to talk to me. So there is, you just have to type it in the chat box. 5, 4, 49, whatever it is. So yes, as Arisha has mentioned, once you give your rating out of 5, you're also supposed to mention where is the problem, right? So that I can help you there. Sama is 4.5. So Arisha had a problem in average capital invested. What about others? Everybody who is less than 5 needs to mention where do they need the support. Meanwhile, I'll explain to Arisha what is average capital invested. Average capital invested is, see, Arisha, look at test your understanding 2. Look at test your understanding 2. Where are we? Here, the capital is 100,000. Okay. And at the end of the life of the investment, it still has a value of 10,000. So at the day 1, it is 100,000. And on the last day, it is worth 10,000. Sorry, day 1, it is 110,000. Again, if you take the average, how will you take the average? 110 on day 1 plus 10,000 on the last day, meaning it has, it's a total of 120,000. And the average would be, again, to get the average, this is 2 readings. So to get the average, you'll divide by 2, meaning that on day 1, if it is 110, and on the last day, if it is 10,000, on average, the capital investment was worth 60,000. Arisha, is this clear?
Yes, this is clear. I just want to ask, like, what is this doing in, like, return on capital employed?
Oh, your voice is very low. Can you type?
Okay.
Anjana, which problems? A, B, test your understanding 1, 2. Osama, you are 4.5. Nitesh, you are 4.5. Anjana, Yashika, 4. Can you let me know where is the problem? What about Harshika? 5. Again, everybody just type. For whatever reason, your voices are very low.
होइन म त मेरोमा क्लासमा छु क्या अनलाइन क्लास कुन हो यो के पठाएको यो जोइन गर्न होला तिमीलाई चाहिँ तिम्रै हो
Okay, so again, what is it doing in ROCE? I mean, obviously, ROCE looks at the capital investment, right? So when you look at the capital that was invested, you either can take the original capital or you are taking the average capital. That's it. Average is first day, last day divided by 2. Sadia is 5. Nitesh, Anjana, Yashika, where can I help you? Anjana is at second question. Here, this question A or B or both?
A.
A. A is easiest. See, they want ROCE. So if you want to calculate ROCE, it's simply PBIT divided by initial capital. So you don't even need to calculate the average capital. Again, 2 ingredients you need. Okay, you need 2 ingredients. Anjana, first is PBIT and second is initial capital. And the question clearly says what the initial capital is. It is 800,000. That part is there. All you have to do is calculate the profit.
Located in the heart of Barcelona, it provides quality education for every international students.
Okay.
It provides English oriented program and dual certified for Spain and UK. It also provides opportunity to get for working.
Okay, done. I have successfully muted. Okay, so again, PBIT divided by initial capital. Initial capital is there, Anjana. PBIT you have to calculate. How? First of all, there are so many cash flows. So you will take the average. So first step is to take the average cash flow. And Anjana, how will you take the average cash flow? You'll take the average cash flow by adding up all, dividing by 7. How much was it? 150 plus 200 plus 300 plus 400 plus 400 plus 200 plus 100. Add up all. How much is the total?
It's 5 o'clock.
200 plus 400 plus 400 plus 300 plus 200 plus 150 plus 100 is 1750. Is it 1750 divided by 7? Yes. So the PBI, the cash flow on average, Anjana, average cash flow is 250. How did you get that? You added up. Yes, Janvi, the ones who are clear can leave. You added up and you divided by this by 7 to get average, which is 250. From that, you will deduct the expense, and the expense is depreciation. So you have to calculate the depreciation. How? Again, the asset had a value of 800,000, from which 100,000 was not depreciated because it was the scrap value. So how much was depreciated? 700,000 over a span of 7 years. So the yearly depreciation is 700,000 divided by 7, which is 100,000. So the yearly expense is 100,000. So the yearly annual profit is 250,000 minus 100,000, which is 150,000. And you got this ingredient also. Now simply divide 150,000 by 800,000 into 100 to get the answer. Anjana, is this clear?
Yes, sir. Thank you.
Anybody else? Anything else you want to know? All clear? Cash flow minus depreciation for every year. No, you'll not do it year by year. You're taking the average. You're taking the average cash flow. Nitesh, look at this. You'll take the average profits, and to get the average profits, you'll also take the average cash flow. Okay.
But sir, actually, it is still telling to me, we purchase will be sold for $1 lakh. So it is a scrap value. So it is also called a depreciation for the every year is cash inflow is 100. It is so and it is also sold 100 for every year. Then I calculate 1050 divided 7 equal to 150 is average profit 150, and I already
So
calculated.
basically, I understood your question. Basically, the question, what you will look at is calculate the yearly depreciation.
Yes.
How much is the yearly depreciation? Without any doubt, it is
Yearly.
again 800,000 minus 100,000. 100,000, why are we deducting? Because it's not depreciated.
Yes.
There is still value of 100,000 at the end of the period. So the depreciated amount was 700,000. It was depreciated over 7 years. So the yearly depreciation is 100,000. Is that clear?
That means at the end of 7 year project, the assets essentially purchased will be sold for 1 lakh. So in last year, sir, I am telling.
Yeah, in the last year, it is sold for 1 lakh. So that's why I am not depreciating that. I'm depreciating only the balance.
Okay.
You are selling it for 100,000, but remaining 700,000 has to be depreciated, right?
Yes.
So I'm depreciating that.
May I, sir, calculate every year for
Wait,
one
I'll come to that
100.
part. Let me come to that part. See, this asset that you have, you bought it for 800,000, you deduct 100,000 because you sold it for 100,000.
Hmm.
So you depreciated 700,000. 700,000 over 7 years is 100,000. But when you talk about this,
Yes.
this is not your asset that is getting, that is being worn out. It's not an asset that is it's getting wear and tear for. This is your cash flow. This is what you are earning. Please don't depreciate that. This 100, 200, 400, 400, 300, 200, 150 is your yearly earning. You will not depreciate that because depreciation is drop in the value of an asset due to wear and tear. This, what I've marked here, is your cash flow. How much did you earn in each of the years? So please don't depreciate it.
Sir, but sir, cash flow is every year is 100 and a yearly depreciation is 100 also. Then
No, wait, 1 second. Who told you that the cash flow is 100,000 every year?
Yes, sir, 100,000, no, sir. I am cash inflow is first year is 1 lakh, second year is 2 lakh, 4
Yeah.
lakh, and my yearly depreciation is 1 lakh.
Yeah.
May I calculate ki every year my cash flow is already looking this in book, but I deduct the depreciation for each year, 100 every year.
No.
No.
That's what. Okay. So see, you're saying that first year my cash flow is 100,000. So I'll deduct 100,000 and I say first year there is no profit.
Yes.
Second year I have a cash flow of 200,000. So I deduct my depreciation of 100,000 and I say I have a profit of 100,000. You're
Yes.
saying
Yes, sir.
not do it this way. What we will do is, because your cash flows are different every year,
Yes.
we will take an average cash flow for each year,
Okay, sir.
right? So the average cash flow. So this is, I understood your question. So can I deduct yearly depreciation from the yearly cash flow to get the yearly profit? You make your life easy.
Yes, sir.
How will you make this? Is something more complex. Instead of doing it yearly, just take an average.
Yes, sir.
Average is whatever answer we got. How much was that? Average is 100 plus 200 plus 400 plus 400 plus 300 plus 200 plus 150. Right? Divided by 7, and then you will directly just deduct 100,000 from the average. You don't need to do it year by year. Are you understanding, Nitesh?
Yes, sir. I understand.
All right. Anything else?
No, sir.
All right. Okay, guys. Thank you so much.